Okay, so thank you, Don, and thank you everyone for joining tonight to listen to my talk. I wanted to kind of cover some of the topics that are, I think, obviously very relevant given the recent market crash. So, and I do have quite a lot of content, so I'll try to kind of cover most of these aspects, but obviously you can follow up with me if you have questions either by email or through LinkedIn. About myself, I won't spend a lot of time talking about me because I've already done other talks before. So you, but anyway, I work at SAS. I do software development in risk management, and here's my contact details in case you want to reach out to me by either LinkedIn or by email. Before we start, it's important to do a disclaimer. So obviously, I'm not a financial advisor. So anything that I say tonight is for educational purpose only, and you should trade at your own risk and take anything as I say as not as a financial advice. So having said that, let's start. So first of all, I pulled up a chart of the S&P for the past about 20 years, give or take, and I overlaid on top of it the VIX just to show the increasing volatility. And if you just look at what happened in the past, well, a week or so, on the 5th of August, sorry, it was like 3 weeks ago almost. It didn't look like a lot like a crash in the sense that, yes, the market went down, but it was only 200 points. It was about 3% down in one single day, which is not really unusual for the market. And I'll show you some statistics about what the market does. But what was relevant about that crash, if you want to call it that way, was the huge spike in volatility. That's probably what wiped out most of the accounts of a lot of people that I've heard of, that I've actually had a lot of kind of bad stories of people who really got wiped out. So I was going to bring up this slide just to say that in my kind of layman term, like a crash is anything that can really wipe out your account. So it's not necessarily something that is the market is going to drop by 10%. It could be related to other things, especially if you're working with options where the direction is not the only thing to keep in mind. So what I've seen a lot on the web is a lot of promises, a lot of strategies that are typically relying, kind of dance around this concept of selling naked positions, whether it's a naked put, naked calls, or strangles, or some variations of that matter like the 1-on-1, 1-2 trade. These are all kind of different variations. But long story short is you always have the main income portion of the trade is made by a short put. And the kind of the focus on everyone when they talk about this thing is always about the win rate, how high the win rate, especially if you sell a far out of the money put. So in this example, we may pick up a delta 5, which in theory should give about 95% of probability that at expiration the underlying will stay above that strike price. So that sounds very good. You look at it and say, wow, 95% probability of win rate. That sounds amazing. So a lot of people, keep doing this, and month over month, especially in the past 4 years, where the market has been, pretty much going up. This sounds like a great strategy. Until events like the one of the August 5th come in, and then all of a sudden everybody is kind of waking up to the reality of what these type of strategies can bring in. So again, this is not just to bash against the naked put, but it's just to warn people about the type of risks that can come with it, and that there are ways by which you can mitigate these risks. So I'll talk about some of these aspects today, as well as other type of strategies that you might want to also consider, not to just rely always on naked puts. So if you just look at this chart, basically this is the bars. It's a histogram of the daily returns of the S&P 500, and the red line is what the normal distribution will look like based on the data of the S&P. And the first thing that I want to point out is how the red portion of the line only covers 3 standard deviations either way from the mean, which means that if the S&P returns were truly normal, you would see basically the blue bars only within the range of the standard deviation, which of the normal distribution, which is displayed with the red line. However, as you can see, we have a number of bars on the left side as well on the right side, where as you can see, basically the losses that could be generated. Well, I mean the occurrences on which the market moves way above 3 standard deviation is actually quite more frequent than we think about. And so this is to say that essentially the returns of the market are not really normal. They are more distributed according to well, they're fat tails. So this is what it's called typically leptocortic distribution. Another thing to keep in mind is the fact that if you look at where 5 delta stays, it's in this area. When we talk about 95% probability, but at expiration, it means that the chance that by expiration the underlying will be on the right side of this line. However, it could still be the case that throughout the life of the trade, the underlying moves and passes that strike, and then although it comes back in. So yes, there could be occurrences where the underlying gets all the way on this area, and so the question is, will you be able to sustain those cases when the market drops even below your strike price? So this is just to show how was a short put, a 30 days expiration short put open on August 2nd with a delta strike of with a strike of 5 delta. The first thing I wanted to look at was what is the reg T margin? So how much margin usually a broker will ask you to open a position like this? And if you look at the reg T, is about $6,000 for this particular. This is a position in SPY. So it's the strike is 550, and sorry, the underlying the spot price was at 554, and the strike price was 503. So we're about 50 points, 51 points away from the other money. This, according again to the margin rules, it would cost about $66,000. However, sorry, if you look at the what the typical portfolio margin would be for those who have a portfolio margin, typically the brokers look at somewhere around the 15% neighborhood. I say neighborhood because depending on the broker, some brokers may, I think Thinkorswim goes all the way down to 18%. Interactive Brokers claims on their website page it is 15%, although sometimes it looks like it's even more than what they are claiming. Long story short is typically portfolio margin is based on the fact that you're looking at the T0 line and where the minus 15% mark is. Well, they basically look at what would be a stress of minus 15% down in the market and what would be the loss corresponding to that drop in the value of the underlying. So if you look at this, that would be about 3.5, so $3,500 of margin. So half, well, a little bit more than half of what the reg T margin would be. And I also wanted to look at what would be the projected loss if we touch that strike. I mean, if you ride at the strike, according to this model, you should see about $1,000 loss. Now, is that the case? Well, 3 days later, this is the situation. This is at the opening of the market on August 5th. So if you look at the reg T margin, the calculation now has increased to $9,000. So that's quite there's a 50% increase in the margin requirement just by looking at the reg T. If we look at the portfolio margin, again 15% from the current at the money, that would mean $5,500. So quite an increase there as well. But what brokers also do is, at least if you look at how Interactive Brokers does it, they also shock the volatility and they simulate what would be an increase in volatility of about 75%. So according to that calculation, that brings your margin to about $7,000. So my point in all of this is that even though the underlying has not even touched the strike, the margin has basically doubled. And so some people may have actually have a margin call basically from the brokers because they may not have enough capital to hold the position. So the danger with this type of position is that it's not just whether you can you're 95% of the time you win or not, but it's also the fact that you may not be able to bring the position, your trade to expiration because of a potential margin call. So what I really wanted to focus is not really on the win rate, because in my mind, win rate is totally relevant. What really matters is profitability. Now, how do we measure profitability? Is by looking at essentially the expected value. And way to calculate this, I mean, according to the formula, it looks like complicated, but it's not that complicated. Essentially, here, E of X is the expected value, is our essentially whether in the long term our strategy will be profitable or not. The X value here represents the P&L value. So every possible profit or loss that we could see throughout the strategy, and in all possible scenarios. And P of X is the probability distribution function that describes basically the distribution of how these losses or these profits might be might occur. Now, this is very mathematical, description, so it might not make much sense to it. So let me just give you like a kind of more practical example. If you have a coin toss where you have a certain probability P of winning and a probability of Q, which is equal to 1 minus P of losing, let's say 80% of win and 20% chances of losing, well, your expected value would be 80% times the amount that you would win when you actually win, and minus 20% times the loss, which would be the amount that you would lose, I guess, in case of a bad coin toss. So by using this simple formula, we can basically calculate what the expected value is for a simple coin toss. The reality is that we are not really dealing with coin toss. We are dealing with complex distributions, complex P&Ls. So how can we bring kind of approximate the complexity of the world with something that resembles a little bit more like a coin toss? So let's start with a simple example. And if we look at the distribution of the P&L of a short put, so if I'm selling a put, essentially, if we look at the normal distribution, again, assuming that everything is normal, and although we know that it's not exactly normal, we know that when we sell a put, if by expiration our strike is not breached, we will collect the money. So let's say if I sold the 10 delta put, I have about 90% probability of making the money, basically keeping the premium that I collected. So that this bar that you see right here represents your 90% probability of winning the entire premium. Of course, if the strike is breached, there's still a regional buffer before you actually get to zero P&L, and that's because the underlying needs to move past your strike price by the amount equal to the premium that you receive before you actually start losing money. So this portion you see on the left side essentially is the left tail of the distribution, while all the probability that would be contained on the right side is kind of collapsed into a single point. So this is the distribution of a short put. Now, it's not exactly like a coin toss, right? However, what typically people do when dealing with naked strategy is to add a stop loss. And so essentially, when you do add a stop loss, essentially what you're doing is there's a certain probability that you're going to hit your profit target. And also there's a certain probability that you may hit your stop loss. And when your stop loss is hit, you know more or less at what point, at what value your loss is going to be. Whether it's a 2x stop loss or 3x stop loss, it means that you're basically cutting your losses. So you're collapsing all of the left tail of the distribution to a certain point, obviously on the left side of the zero, but still maybe 3 times the premium or 2 times the premium, but not more than that. We all know that stop losses don't work that well, but because there may be gaps, because there may be a lot of different reasons. But if we take this simplified model where you have when you win some money, when you lose, when you hit your stop loss, you lose some money. Now this almost resembles like a coin toss where you have a certain probability of win with a certain win amount and a certain probability of loss, obviously with a loss amount. So essentially, what do we want is make sure that on the long term, the expectancy of this strategy must be positive. We want that, yes, we might win 90% of the time, but if 10% of the time that we lose the entire amount that we earned in the 9 times before, then it doesn't really help us. So this formula really, it's a simple formula to tell us, basically to find out what conditions must be respected for us to have a positive expectancies in the long run. You can look at this in two different ways. Essentially, if you know what the loss amount is and what the win amount is, let's say that you have a strategy that when you win $1, and when you lose $2. Well, if you look at this simple formula, is the loss is 2, the win plus loss is 3. So that means that you have a 2/3, so it's about 66%. So you need to have a win rate above 66% for that particular strategy. So this is a simple formula that helps you understand what kind of probability of winning you need based on what is your win and the loss amount. This other formula essentially is basically looking at, if you know what the odd ratio is, the win to loss probability is, the win rate is, which is the number on the right side. You can also calculate what's the ratio of winning versus losing amount that you need. So why do you look at this one? Well, we need to have all the three components. We need to know what the win rate is, and we need to know what the probability of losing and the probability of winning P, and the probability of losing, which is 1 minus P. So how do we calculate this? Let's just start with a simple practical approach. So if, again, if you have a simple naked, we know that the probability of profit essentially is the probability of reaching the break-even point, right? So if I bought a long put, and obviously I'm going to make money if my underlying is going to not only breach the strike, but it also needs to move all the way past the break-even point. So the way to look at this is we can look at what is the strike that is the closest to the break-even point. We look at the delta of that strike, and we know that the delta is approximation for probability. So essentially, the delta of the strike, which is the closest to the break-even point, is telling us that is the probability of profit by expiration. If instead of buying the put, I've sold the put, in this case, well, the delta will be the probability that that value would be breached. So in our case, since we sold the put, we want to make sure that that strike doesn't get breached. So if I have a 5% probability that the strike is going to be breached, well, then it means I have a 95%. So 1 minus the delta gives you the probability of not breaching that break-even. So this is super simple if you have a single leg. Now, what happens if you have a spread, or if you have more complicated structures? So if you have a spread, sorry, can you guys please go on mute because it's very loud. Thank you. If you have a spread, whether it's a long spread or short spread, essentially what you're doing again is looking for what is the break-even point of my strategy, and look at what is the delta of the strike, which is the closest to that break-even point. And again, either the delta or 1 minus the delta is going to be the probability that you're looking at, depending on whether you're long the spread or short the spread. Okay, fine. Now, what happens if you have a range? So, for example, you could have a butterfly, you could have a condor, or or somewhere some strategies in between. Well, here again, it's actually quite simple. What we do is we look at the break-even points on each side, and we look at what is the strike that is the closest to those two break-even points. And the difference in delta essentially is your probability of profit. Again, all of these probabilities are calculated at expiration. We're not talking about anything before. The underlying could move past those values during the life of the trade, but eventually, according, the probability is telling you that the pop essentially is the probability that the strike is the underlying will land within those two break-even points at expiration. Great, but do we actually trade at expiration? Well, apparently many people do this, but I personally think that you should consider not doing that for multiple reasons, which we'll try to talk about today. And so how do we calculate this? If, for example, I have a structure, and in this case is a broken wing butterfly, and let's say that my broken wing butterfly has an expiry date of, I don't know, 90 days, 100 days from today, but I know that my strategy assumes that I'm going to be closing this 30 days, 40 days from now. So at any point in time, essentially what you do is you look at the T plus N. So you look at how many days from now you think you're going to close this strategy. Let's say that N is 30. So you will look at the T plus 30 line. You see the break-even points for that line. And then you would go and look at the chain with an expiration as close as possible to those 30 days, to the T plus N line. Well, you go to the expiration, sorry, you go to the chain and you look at the strikes, which are the closest to the break-even points that you just looked at. And so the delta between those two, the difference between the deltas of those two break-even points, again, will give you what is the probability of a profit by that time. In this case, it would be by 30 days, even though the structure has an expiry date of 90 days or 100 days or whatever the number is. So again, you always look at the break-even points, you look at the deltas, and that helps you understand what's the probability of making a profit. Now, why am I making so much noise about all of these things? Because, well, I may actually run a backtest. So here's an example of a backtest of a strategy that actually performs pretty well. We look at it has a 83% win rate. The loss amount, the average loss is about $1,700. The average profit is $1,800, so it's almost 1-to-1. So if you do the math, I need at least 48% probability of win rate for this strategy to be positive. And in this case, we have 85%. Well, sorry, 83%. So obviously, this is a good strategy. So, well, why do we care about all of these formulas if we can just look by the equity line and have all of these numbers? Well, the point about this is that even though the strategy might have a CAGR of 42%, which sounds very good, the max drawdown is almost 20%. Essentially, this is a quite aggressive strategy. So I might want to try to smooth out this equity line. I might want to reduce my losses. For example, trying to reduce the max loss, or which in this case was $7,000. Or I may want to try to reduce the drawdown to maybe 15% or 10% if I can. So obviously, when I try to reduce this thing, it means that maybe I'm gonna add more stop losses, or maybe I'm gonna add some different exit strategies. And whatever I do will inevitably impact my win rate, because obviously if I had a stop loss, my win probability is gonna drop down. But what I see from this formula is that I still have quite a room to go from 82% all the way down to 48%. So I have quite a lot of margin for me to move things around. And if I'm willing to maybe accept a lower compound annual growth rate, but I may want to trade off this for a lower drawdown, and that means also potentially lowering my win rate. But again, overall, that tells me that I do have some margin for maneuvering and changing things around. If I already have a strategy where my existing win rate on the backtest is very close to the theoretical minimum win rate, well, there's not much for me to do. But basically, I can't improve anymore, because any change that I make, it may actually make things worse. So that's why I was talking about these aspects. All right, so but credit or debit strategies is credit strategies all that we can do. And one of the I think common misconceptions that I see around YouTube and nevertheless is that basically selling out of the money strategies is better because these are better because they have positive data and because you have a high win rate. Essentially, if the market doesn't move, you make money, because every day that goes by and the market doesn't move, you're fine, your theta is positive and everything looks cool. The reality is that it doesn't really matter whether you are, well, if you buy instead of getting a credit, you may think, well, I have a negative theta, so now every day that goes by, I may lose money. Well, the reality is that it doesn't really matter whether you are using a credit strategy or a debit strategy. What really matters is the T+0 line, because the real trading happens on the T+0 line, not at the expiration line, because that expiration line usually it's quite deceiving, as well as the Greeks. You have to look at the T0 and the Greeks, and that's where the real trading happens, in my mind. So it doesn't matter whether you do something for credit or for debit. If you have a positive theta, as a result of your strategy, even if it's a debit strategy, it's okay. It doesn't have to be always for credit. You have to look at the theta. You have to look at obviously all the Greeks, the Vega, the gamma, the delta, and and all the second order Greeks as well, and third order obviously eventually. So, and just to give an example, if you look at an iron condor or versus a condor, iron condor is a credit strategy, a condor is a debit strategy, and yet you can construct them so they basically have the exact same P&L, same Greeks, everything is the same. So you can construct the same story with a butterfly versus an ironfly. Essentially, one is a mirror image of the other. Yet one is a credit strategy, the other one is a debit strategy. So it doesn't really matter again whether it's a debit or a credit. What matters are the Greeks and the risk chart. So what are other types of strategies? There's plenty of strategies. So I'm just gonna show a couple of them just to give you some ideas. Here's a broken wing butterfly where you have with deltas of 60 for the upper long, 40 for the two shorts, and delta of 20 for the lower long put. So the net delta of the strategy essentially is 0. You can see it on the chart in here. And the theta is positive. So even though the structure is obviously you have to pay a debit to open the structure, as you can see, the theta is positive. So that means that as time goes by, structure is gonna make money, obviously within a certain range. So another example on the right side is what I call like a shark tail, because it kind of looks like a fin on here in the middle and a tail of a shark on the back. You can construct this as a 1 long, 2 short, 2 long, or one. So in this particular example is a upper long is 1 put with a delta of 60. You have 3 shorts at a delta of 30, and you have 3 long with a delta of 10. So the net delta, as you can see here, again, is close to 0. Obviously, you can adjust a little bit the strikes to get to complete flat delta if you want to. It still has positive theta. So this is an example of a strategy that not only has positive theta, it has a range. It's range bound, so within it covers, well, a little bit less than 1 standard deviation. But the other aspect is it has a hedge built in, because if the market went to go down, you would have a protection. If the market had a fast move all the way down, you have quite a good protection on this side. Plus, not to mention that this is very efficient from a portfolio margin perspective, because it actually, depending on which broker you're using, they may actually give you margin rather than ask you for margin. But that's another story. Here's another example of 2 calendarized strategies. They again are for debit, and they have flat delta and positive theta. On the left, we have a double calendar. These are on the right side, you have a call calendar, and on the left side is the put calendar. These are both delta 30, give or take. Obviously, you can play around with the deltas and make them closer, make them farther, but the whole point is, again, if you look at the delta is close to flat and the theta is positive. Now, what I don't like about the structure, I mean, just by looking at the risk chart, you can see that the T0 line is quite, it's not very flat. So the gamma is actually quite strong. It's a high negative gamma. You can see right here, it's a 0.02, which sounds small, but it's actually not that small. That means that this structure has a quite high gamma risk. Obviously, it's a high theta because this was actually done on I think it was a fairly short, I think like 14 or 20 days to expiration. So just to give you an idea of what it looks like. But again, you gotta be careful because this particular structure has a high gamma. Well, of course, if you go farther out in time, and we'll look at this later, things get better. On the right side, this is another type of structure. I call it time fly. I don't know if there's an actual name for it. Essentially, it's like a butterfly, but all the 3 legs of the butterfly, instead of being on the same expirations, they're all the 3 on the same strike, but 3 different expirations. So you have one long on a short dated expiration, 2 short on a expression which is behind, and then one long in the third expression even farther away. So and again, same strike in this case of 5,610 in this particular example. So this is the risk chart. You can see that the gamma is basically flat. The delta is also quite zero. Although if I look at the graph here, it doesn't look that flat, to be honest with you. But for some reason, I believe that this gamma is not correct, because when you're looking at three different expressions, so the calculating the gamma across the different expression, Optionality Explorer cannot do it correctly. So I would be very careful with that. But if you look at the T0 line, obviously it's not very flat. So there's a gamma risk in here as well. Again, because of the distance and everything else. But this, again, just to show you how you can construct trades which have fairly flat delta, fairly flat gamma, fairly positive theta, and still be Debit strategy. So you don't have to always go for naked strategies to make your income. All right, so I showed you how the gamma risk was a little. I mean, I talked a little about the gamma and how this could be a risk. So before we get to the point, I wanted to cover a little bit about the time and volatility. So both the time and volatility are two kind of close cousins when it comes to options, because they have a very similar effect on the price of an option, even though it's not exactly the same. So when you add time, it is like, to a certain extent, like adding volatility, but it's not exactly. I mean, obviously, adding more time, it's like adding volatility, but the effect is not the same way. And I'll show you in a moment through this piece of software that I built. But the reason I'm telling this is because in low volatility environments, you might want to consider to pick up further dated expressions, because that will basically kind of make your range of movements a little bit wider. So if you look at this chart on the right side, the blue line is a 1 standard deviation. Both the blue and the red lines are two normal distributions. The vertical dotted lines represent the first standard deviation for the blue line and for the red line. And the red line has a basically higher volatility, which obviously is wider. So what this is telling us is that if we increase the volatility, or if we increase the time, which has similar effect, essentially we are widening the range that our strategy might cover. And so this means that we're basically reducing to a certain extent a little bit the risk on the in the short term period. Again, because I'm talking about not bringing a strategy all the way down to expiration. I'm always, at least in my trading, closing my strategy quite well before the expiration. So that means that what I really care is how much range do I have within the time frame in which I'm going to be in the trade. So that's really what matters. It doesn't matter whether you can cover 2 standard deviation on an expiration that is too far away. What really matters is like how much coverage you have in terms of the underlying movement from now until the time when you think you're going to be out of your trade. That's really what's going to help with what's going to make or break your strategy. So I'm gonna quickly jump into this chart on the left side. So what I built is a little collab. So you have this link over here. You can scan the QR code, and anyway, I'll add the link. I'll give it to. We'll put it on the video later on. It's a simple collab. Essentially, you can choose your trigger symbol. In this case, I chose pi. You can choose a delta. So, for example, 0.4 means a 40 delta. And if it's negative, it means we're looking at the put. If it's positive, we're looking at calls. And then you can say what the interest rate is today. And what this is going to do is essentially compute this chart over here. What this is showing is basically first of all, this plane that you see, the gray plane, represents the at the money. And the vertical axis is the distance from the at the money. So as we go down, it means that we're going far away. So for example, -2%, 3%, -4% away from the at the money. Now, what do we have on the x-axis and the y-axis? We have the implied volatility, and the time to expiration. So let's look, for example, for a moment at this graph by just looking at the distance as a result of the implied volatility. What this chart is showing me is that a 40 delta put, the distance of that put is going to be as we increase the volatility from 10% to 15 to 20 to 25%, that put is going to go farther and farther away from the money. And as you can see by this line, it's almost in a linear fashion. So it's almost proportional. So if I double my implied volatility, my distance from the money almost doubles. It's not exactly linear, but it's close enough. Now you might wonder why. If you reduce the volatility, the put goes all the way up, even above the money. That's because of the effect of the interest rate, but that's probably a topic for another time. What we're looking on this side instead is the same distance, but this time by looking at increasing expiration. So as you increase the DT, you can see that yes, you're getting farther and farther away from the money, but it's not a simple straight line. It goes with the square root of time. So you can see this, basically this chart is kind of showing you the two coins of the time versus volatility and the effect that they have on how farther you get from the money as a result of either increasing time or increasing the volatility. Also, what you see in this chart are these lines on the bottom plane. These are the isometric lines. Essentially, what this is telling you is that any line, if you follow basically all the points on a particular line, these are all combinations of implied volatility and days to expiration, for which the distance remains constant. What do I mean by that? So, for example, if I take a 20% implied volatility and 359 days to expiration, my distance from the money will be about 2%. So here it shows like 1.98%. If I move along this green line, all of this, if I can manage to find this exact same line, as I move around these green lines, basically, you will see that you have maybe lower DTs, but higher implied volatility, and the distance will still remain the same. Now, I'm not able to exactly pinpoint the value, so maybe I should zoom on a little bit. But essentially, as I move around this line, you will see that essentially the distance remains constant, okay? And these are all possible combination of days to expirations and implied volatility that gives you the same distance from the demand. All right, so you can play with this thing later on if you want to kind of understand a little bit more the effect of time volatility. So why am I talking about this? Getting back to my slides. Is because let's take an example of a short-dated broken wing butterfly. And I'm looking at 0 to 5 days to expiration. And let's see what happens what are the pros and cons of this strategy. Well, on the advantage side, the only thing that I can think of is essentially the theta. It's a very high theta, which means that this structure is going to go to profit very quickly. Obviously, if you are within this main range where the T0 line will eventually turn into the T+1, which is the red line, and then in this case it's going to become the red line, the expression line. This is a 2DT butterfly, so obviously it's about to go to expire, so the theta is extremely high. So that is the only good advantage of this. Now, on the disadvantage side is that if you look at the range of profit, it's fairly small. So yes, it covers about 1 standard deviation. So this is this BWB was created with a 40, 30, 20 deltas, and so it covers almost 1 standard deviation. But if you actually look in terms of absolute numbers, it's from the break-even point, which is 5,406, to all the way down to maybe this point right here. It's about 5,550. So it's about 150 or 120 points, give or take, which means 60 points up or 60 points down within 1 day. It's not too bad. But it's, obviously the market can move easily 100 points, so on either direction. So it's not that uncommon to see this structure like this, basically to be blown off. So obviously the range of profit is fairly small. The Vega is quite high, especially the weighted Vega. Here this Vega, it's actually -11, so you may think, well, it's not that high. The reality is this is a very short dated structure, and if you calculate what the weighted Vega is, it's actually about 120 or 130 for this structure, give or take. So it's fairly high. So you have more Vega exposure than you think if you just look at this risk chart. There's a high gamma risk. Again, the gamma here is a 0.03 negative, but you can just look at the T0 line and T+1 how bent this is. Now, why is gamma risk a bad thing? Because essentially gamma could be your best friend or your worst enemy, because in a moment your strategy could go from full profit to full loss just by a simple movement, by a small movement of the line. The higher the Vega, the more your strategy is going to make or lose money as the underlying moves up and down, even by a small amount. So gamma risk is very important, especially on short-dated options. And the other disadvantage in this case is the fact that if you look at the both the Reg T margin and the portfolio margin for this structure, essentially they are exactly the same, because they will both the portfolio margin will look at what would be your loss if the underlying move 15% down. Well, 15% down, you're essentially are at max loss. I mean, this chart is showing you like 3% down, and you already reached max loss almost. So that's the portfolio margin will be exactly the same as the Reg T. So obviously this structure is not efficient from a margin perspective. I want to be clear that just because I say that something is efficient from a margin perspective, it doesn't mean that it's always a good thing. I mean, low margin is not necessarily a good thing. You have to be careful, because low margin does not mean low risk. It means you have a higher leverage, which could be a good thing or a bad thing depending on how you deal with this. So be careful. Just because you have a lower margin doesn't mean that you have a lower risk. The risk is always there. You got to be careful with what could happen to your strategy, and that's a better indication than just looking at the margin. Now, things to consider is this structure is fairly, if you look at a single tranche, this is a relatively low cost, but that also means that if you look at your profit target, a strategy like this would have about 5 to 10% maximum of profit target. I'm talking about 5 or 10% as a percentage of the maximum loss. So on a $600 maximum loss, if your profit target is 10%, which is already quite high, it means you're trying to collect $60 out of this strategy. But this thing is going to cost you about $8 in commission minimum, plus exchange fees and whatever. So reality is probably like $15 to $20 in commission. So out of the $60 of profit, that's a high impact on your profit, right? The impact of the commissions on your profit is fairly high. Another thing to keep in mind is that it requires a very active and responsive management on this trade, because again, the market can move very quickly, and because of the gamma risk, you have to basically be in front of the screen to watch it, or to do your corrections, or get out of it very quickly. So if you don't want to avoid a big drawdown. So again, this is the shorter the days to expiration, the higher the gamma risk, the higher is the risk you actually take in general on the position. On the opposite side, I went all the way out and say, well, what if I take same structure in terms of probabilities? So again, it's if you look at the deltas, again, it's a 40 delta for the front long put. It's 30 delta for the short, and 20 delta for the lower long on the back. So from a statistical perspective, is exactly the same probabilities at expirations on both strategies, because deltas are, well, fairly behaving the same way, even though the farther out in time we go, delta tends to be less predictable probabilities. But for all intents and purposes, we can say it's a fair comparison. Now, what's good about this strategy is, well, anything that was bad with the previous one now kind of becomes good with this one, because you have a much wider range of profit. If you look at the overall range in terms of absolute numbers, it's really large. We go from 5,000 all the way to 5,800. So it's 3,000, 300, even almost 400 points, more or less, depending on how you look at this. The weighted Vega, even though it shows, even though the nominal Vega shows 137 on this side, the actual weighted Vega is around 50. So this is a strategy that, from a Vega perspective, yes, it's negative Vega, but it does not have a huge amount of Vega risk compared to the one that we were looking at earlier. Looking at the delta and the gamma, they're essentially flat. I mean, the delta is, well, it is slightly negative, but depends on how you construct this trade. But if you look at the T0 line, essentially it's very flat for a very long range. This means that this strategy, in theory, it shouldn't suffer either way when the market moves up or down within a fairly large range, because the delta and the gamma remain flat for a fairly large range. And it's also efficient from a user margin, because if we look at the minus 15% line, which is somewhere around here, you can see that the margin would be about $4,000 compared to the Reg T, which would be the maximum loss of a little bit above $8,000. So this takes half of the margin that would be required if you have a portfolio margin, obviously, in your account. Now, quick things to consider. If you're in the US, you probably need $150,000 in your account to request a portfolio margin. If you are in Europe, Interactive Brokers, for example, EB Europe, uses basically portfolio margin, even if you have, well, it's not exactly portfolio margin, but it's something very close to it. Even if you have an account which is like $1,000 in it or $2,000 in it, so there's no minimum requirement in terms of your capital amount to get the benefits of the portfolio margin. Now, whether this is a benefit or not, it's something I would be very careful, because unfortunately, because of this, a lot of people tend to size up and they over leverage, and then eventually they can go bust. So it's something, again, to keep in mind. On the negatives of this strategy is the fact that obviously the theta is much smaller. We had what was 71 theta on the for the short dated DT, and we have a 6.4 theta for this strategy. So this is a very slow trade. It's going to take a while for you to get your profit. Having said that, if you look at the other things is the things that maybe kind of less of an advantage is the fact that the liquidity on longer dated options tends to be a little bit worse than the liquidity that you could find on a 30 days or even 0DT for that matter. So that means that your bid-ask spread is going to be a little bit higher, and that means that your actual fill price, it's going to be harder to get a good fill. So you have to be a little bit more patient. You need to negotiate a little bit more. Again, anything goes with when you have a fairly higher bid-ask spread. Having said that, it's still S&P, it's still fairly liquid, but less when you go farther out in time. Another thing to keep in mind, especially with this structure, is the fact that it's sensitive to the skew rotation. So I've done, I believe, maybe a couple of months ago, another presentation where I described the effect of the skew rotation. How do we measure it? We come up with a new Greek that help us calculate what the Vega is specifically for the rotation aspect of it. And so this is a structure that, because it's so wide, it's actually affected quite a lot by the Vega rotation, by the rotation essentially of the skew of the volatility structure. So that's something to keep in mind, and we'll look at an example later on. And another thing to keep in mind that also it goes hand in hand with the skew rotation is the fact that because the bid-ask spread is a little bit wider, what happens is when you place a limit order, let's say I want to have I want to enter my trade for $1 of debit, whatever. Okay. Now, if you place a limit order, obviously your broker will serve you at either that price or potentially better, right? So either $1 or maybe 90 cents, 95 cents, if you like, whatever. However, not the $1 amount is only guaranteed on the total net of the portions that you buy and the portions that you sell. So that's the total net effect of buying some things, selling some things. Altogether, your net price should not exceed $1. But there's nothing as to what the actual price is going to be for the individual legs. And what happens, for example, with interactive brokers is that if you use, for example, the smart route mechanism, they can go and place your orders with one leg with one exchange, another leg with a different exchange or a different prop firm. And so even though your total price might be what you wanted, the individual prices of one leg or the other could be far away from the mid price of those individual legs, especially when the bid-ask spread is wide. And so this can have quite a big implication on your because of the skew rotation. Because if you, let's say you get a very good price on the long legs, but then you get a very bad price on the two shorts, the total limit might be good, but if the skew rotates in the wrong way, you may actually suffer a lot because you had a bad price on those two, and those two are the ones that maybe are causing you more pain when the skew rotates. So again, something to keep in mind. I'm not sure that there's something you can do about it because ultimately, you can't just leg into a strategy one by one, but it's something to keep in mind when you're looking at long-term, longer dated options. Finally, a few considerations about this is that even though obviously if you look at a single tranche, this is a bigger structure, so the cost of this strategy is bigger in terms of margin as well. It's the $8,000 cost, right? If you go with a Reg T, but if you look at the commissions, well, if you take, let's say again, if your profit target is 10% of $8,000, so it's $800. Well, even if you pay $20 in commissions, it's nothing compared to the $800 of profit that you may get from the strategy. So again, commissions in a structure like this become less, have a lower impact, so to speak, compared to a short-dated option. And finally, a trade like this, obviously, because it's such a flat delta, such a flat gamma, it's a little more docile, so it's easier to manage. It's you don't have to be in front of the screen every single day. You can you can look at it once a day, sometimes even once a week, and even if the market moves by 200 points, there may not even be nothing for you to do on the trade to adjust it. So again, it's a much more calmer type of trade. Again, you gotta have the patience of seeing that theta slowly getting you to that profit. So now here's an example of these two strategies. One short-dated, I picked up at 30 days broken with butterfly, and on the right side we have a 200 days, and the opening was on the August 1st. So basically the Thursday prior to the Monday crash. And I chose the Thursday because it was the kind of the after a couple of days of market dropping, then you have a peak. So it might sound like a good time to open a strategy because the volatility was already higher. And as we know, these strategies, broken with butterflies, are Vega negative, so they should potentially make money when the volatility decreases. So in both cases, we're looking at again 40, 30, and 20 deltas. So from a probabilistic perspective, they're exactly the same. I also sized up the one on the left side to 4 contracts instead of 1, so that the maximum, so the capital invested in both cases is the same. Obviously, I cannot match the T0 line because these are two different structures. So it's not an exact comparison, but obviously these are two different strategies in two different expirations. So you cannot exactly match them, but I try to make them as comparable as possible. So what happened with these two with these strategies? Well, the VIX was at 17.40 when we opened it. We look at on Monday morning and at 9:15, so 15 minutes after the open, this is the situation. So the one on the left obviously has lost a lot of money. It's seeing a 33% loss with respect to the $10,000 or almost $2,000 invested, and the one on the right has only lost $759. So as you can see, well, this is the first thing to notice. Obviously, the one on the right, even though obviously it's losing, it's not a big loss, and it's you still have time to look at it. But most important thing is look at these dots. Look at all these dots around the point. The market was so volatile that it was almost impossible to close any position at a decent price, unless you were just going on the ask and basically paying the market price for any to get out of the position. So in a situation like this, it might be even very difficult when you have a market crash to get out of your position. So while in a case like this, basically you have nothing to do, you're almost at max loss, because by the time you try to exit at the market price, you really took a big hit. On a structure like this, you could even say, you know what, let me wait out a little bit and let's see if things adjust. Well, obviously there are other things you can do, but you don't have the same rush and impetus of going and closing the position, because even on a structure like this, and I can talk from experience, because I had a structure like this, which was open a little, not exactly 3 days earlier, but very similar, and I could not close it. I mean, the bid ask was so wide that it made no sense. So I just said, okay, it's $100,000 on a $200,000 account, so it's a 0.5% of the account. Worst case, if I have to lose it, it's fine. It's not a big deal. So you can make those type of decisions because it's a fairly small loss, and because again, you could wait a little bit because the loss is not that big. On the left side, well, you probably have to close it if you really don't want to go all the way to the max loss. So what I wanted to show you is, well, if you look at the structure, right, we're going to be looking at this on the right side. This is the Option Explorer showing you the delta, the gamma, theta, and Vega. But unfortunately, Option Explorer does not show you the weighted Vega, and it does not show you the Vega skew, which is the rotational effect of Vega. So I do have kind of my own Excel software. So I'm just showing you the Vega and the Vega skew. I'm not showing you the other Greeks because they were kind of fairly flat, except for the data that was positive again. But you can see the values on the bottom, right? So you can see that the nominal Vega was 143, but the actual weighted Vega was only negative 54, so much smaller. The Vega skew in nominal term was positive 22. The weighted Vega skew was positive $8. Now, for those of you who may have not seen my previous presentation, like the like one sentence explanation of what this is the Vega skew measure how much money your strategy is going to make or lose if the skew rotates by 1 degree of an angle, okay, with respect to the other money. So you imagine you look at the skew chart as if it was a straight line instead of being an actual curve, and you measure the angle of rotation from the other money. And if that angle were to increase by one degree, what would be the new volatility of all of those strikes, and how much money would I make or lose as a result of that? Now, this is a super quick explanation. If you want to know more, obviously you can look at that presentation. So if I look at this chart and I do the math, well, we know that the volatility, the VIX, went from what was it, 17 to 41, so about like 25 points up. I know that at the peak, it was actually all the way up to 63, I believe, or something like that. But that was about at 8:30 in the morning. So at 9:15, this was the VIX at that particular point in time. So if we multiply 25 points times 54, it gives us more or less $1,200 of loss potentially due to the weighted Vega. So what I also have in this chart is showing you what happened really to the volatility of those strikes that were at 200 days, far away in time, right? So the blue line is showing you the volatility at the time of opening, and we can see that on the 5th of August, the volatility went up on all the three strikes, but not by the same amount. So as you can see, the lower long put had the highest increase of 5.26%. Compared to the two shorts of 4.27% and the long of 3.5%. So this basically means that obviously the effect of the rotation kind of helped us in a certain sense, because it basically increased the value of the lower long put, essentially protecting us a little bit from having a big loss. And if you think about this, is a structure like this, actually going back a second to this chart, where the delta is almost zero, right? So if the market moves all the way down, in theory, you should see a fairly small amount of loss because of delta, because the delta was fairly flat all the way. The theta didn't change because it was only 2 days. So everything else, I mean, the reason why this structure lost must have been because of volatility. That's at least one of the primary factors. So when we actually go and do the math and break down every single component, so this is what we actually find out, is that we made $21 of theta. That's because of the 3 days of passage of time since the time of opening. We lost about $500 of delta. Now, why is that? Because if you look at the delta here, is about 1.45 when we open on Monday morning. So if you take an average between almost zero when we open and 1.45 by the time you're here, just give or take, if you say one delta times 300 points, 400 points, sorry, of the market going down, that's roughly your $488 of delta. I'm just doing a super quick math. Don't quote me on that, but the point is, yes, obviously there is going to be a loss because of the delta. The Vega shift here is showing you that your Vega, the calculation we did, the $50 of weighted Vega that we were looking at right here, $54 times about 24 points of volatility of the VIX spiking, projected at $1,200 of loss, and the actual number here shows us is about $1,000, so it's fairly close to what we actually experienced. And then we had $740 of say protection, so to speak, because of the rotation effect. So this structure in the end lost about $800, but thanks to the rotation effect, we got some of the money back, so to speak. In a structure like a short-dated option, the rotation is basically almost irrelevant. You won't see it because it's too the strikes are so close that the rotation doesn't really help you that much. All right, so what are the takeaways from a market crash? So first of all, something you have to consider is like during the crash, you may not even be able to log in to your trading platform. I have actually an account with Thinkorswim, with Tastyworks, and one with Interactive Brokers. And I know that Thinkorswim experienced a lot of login issues between, I think it was 9:30 and 10:30, something like that. Actually, I was logged in from the night before, so I didn't have an issue, but a lot of people were having issues because they couldn't even log into the platform. So that was the first thing to consider. Second is people started calling the phones and calling tech support at Schwab's and TD and Ameritrade, but those lines were also congested. So they may not have been able to get into their accounts. The bid-ask spread was crazy. So even if you were able to get into your account, chances are is that you may not have been able to exit your position at a decent price. You might have been able to exit, but it would have been at the market price, whatever the market price was asking you. And again, especially if you have structures which are multiple legs, if you have 3 legs, 4 legs, the more the number of legs, the higher, the harder it is to get a good feel, because the bid-ask spread gets wider and wider when you have more legs. If you only have a single leg, it might be easier to close it. Also, again, the margin requirements were super high, and in cases like this, the brokers can basically decide to increase the margin by a lot without any prior notice, and they decide to basically liquidate your position if you don't have enough capital. So some brokers might do you the courtesy of sending you an email and calling you and telling you that, well, calling you maybe not, but definitely maybe sending you an email to ask you to post some more margin if you want to keep your position. Other brokers, like they may not be so good. I know the interactive brokers usually is like they just go and liquidate you, and then they send an email or something about it. So the reality is there are different brokers react different ways, and so you have to be really, really careful with what could happen to your margin requirements. So essentially, what I'm trying to say is when there is a market crash, you have to plan for the fact that you may not even be able to trade at all. So you should try to plan your portfolio in a way that your portfolio should not count on you to save it. You should have a portfolio that can kind of save itself without you even touching it when there are events like the one that happened on 5th of August. So here I try to compile kind of a quick cheat sheet, and then we're going to look at some of the hedging strategies that you might want to consider. So first, let's look at kind of some rules for individual trades. So looking at the individual trade, what are things that we should keep in mind? Well, first of all, look at the maximum risk of your trade, and this is actually a function of multiple things. Is a function of, if you look at your backtest, you look at what was your drawdown, what was the maximum loss that you experienced throughout the backtest, what is the stress margin of that position, and so you should look at all of these three to determine what could be essentially your kind of worst case scenario, and then size your trade accordingly, keeping in mind that you could lose that potential worst amount of money. So how do you do this? The size? Well, a rule of thumb. Now everyone can have different opinions, but I would look at it at least at not exceeding 5% of your net liquidity. Ideally, every single trade should not take more than 2% of your net liquidity, of your entire capital. The reality is, if you have a small account, 2% may be too little to do any trading at all. So you may be forced to go with a higher risk per individual trade. However, I would try not to exceed the 5%, because 5% is already quite high. Think of it like this: if you lose a 5% on a single trade, okay, it hurts, but you may still recover. If you lose a 10%, risk is not symmetric. Now to go now back from 90% to 100%, now you need to make a 12% return to get back to even. If you lost a 50% on one trade of your account, now you need to get 100% on your capital to get back to where you were. So risks, I mean, the losses and profits are highly asymmetric because these are percentages. So keep it small. That's basically the story. Liquidity, obviously use underlyings which are highly liquid, and also look at the expirations. Some expirations are less liquid than others, so keep an eye for those things, because again, when you're trying to enter or exit, it's not just about the slippage and the bid-ask spread itself, but in cases where the bid-ask spread widens because of these events, it may be even harder to get out of your position. Try to have a built-in protection within each trade. That means looking at your delta, your Vega, your gamma. Again, if there's one thing that I cannot stress enough, and probably like, if there's only one thing you remember out of this presentation, is trading does not happen on the expiration line. Trading usually happens on the T0 line, whether you exit or you make a profit or whatever, your margin call happens, they are all happening on your T0 line. So watch for your Greeks, your delta, your theta, your Vega, and your gamma. Those are the ones that really matter. And if you can, try to have some level of protection within your position. Well, if it's obviously if you're starting from a naked, well, you might want to consider a spread instead of selling naked. That's not a lot of protection, but it's, I mean, well, it is some level of protection. It's going to cut your losses to a certain amount. So you have to try to at least have some level of built-in protection, at least in every single trade if you can. Another super important point is this: what if you look at the Dusty trade, they keep saying trade small, trade often, and some people say, well, you say that because you're a broker, you want to just make a lot of money in commission. They might even be true, but the reality is, when we looked at earlier the formula for the expectancy, where we calculated the probability of winning, the average win, the average loss, and that simple formula, well, that formula to converge to reality that you actually experience, it means you need to have a lot of occurrences, because this is the law of the large numbers, and there's a theorem called the central limit theorem that basically tells you that convergence happens with the square root of the number of occurrences, which means that you need to have a lot of occurrences if you want to converge to your expected value in the long term. You cannot just have few trades. So if you trade few times, but you trade big on those trades, you may end up wiping out your account before you fully experience the benefits of your long-term positive expectancy. So before you size up your trade, first increase your trade frequency. And how do you do that? For example, use a campaign style of trading, which means that let's say, instead of entering once a month, if you want to double up, don't enter with once a month with double the size, but enter every 2 weeks with a new strategy, with another trade. Now, this way you are essentially spacing out your trades, you are diversifying across time, and obviously when you do that, try to avoid reusing the same expiration, because otherwise you may be concentrating all of your risk in the same expiration. So if you do, let's say, one trade, let's say twice a month instead of once a month, well, every 15 days you open a new trade, you look at the expiration, which is 15 days far apart, and then 15 days later you open another one, which is again 15 days farther behind. So you're always picking up a different expiration, so you're not concentrating all of your risk in a single expiration, because if the market crashes up and on a single expiration, then it will wipe out your entire position. So you have to be careful for that. So these are kind of some basic rules that I think of for individual trades. There are definitely more, but these are, I would say, the most important ones. Now, what happens at the portfolio level? You also have to look at the entire portfolio, not just at the individual trades. So just by looking at the deployed capital, so if you have a $100,000 of capital that you are in your account, well, the first rule should be that keep at least 40 to 50% of your capital on the side as money. Why that? Because first could be for opportunity trading. For example, when events like Monday happen, when the crash is happening, and after that, the volatility is going to be high for a while. So this might be a good time to enter new trades. You can't do that if you don't have enough liquidity. Also, for the reason that I explained before with the margin requirements, if your margin increases, you may not be able to survive that event. So keep some money on the side to cover for your margin, potentially increasing margin requirements. Having said that, you should have already sized up correctly your trade to begin with. But it's always good to keep some money on the side for those rainy days. Now, when it comes to the remaining capital that you're going to be using for trading, I would say, and this is something that you could, I think, even you can find on YouTube. I remember, I think, Test Trade used to give some guidelines in the actual percentages of how much you should invest. I mean, in my mind, I think if you are in a low volatility environment, you may want to stick with 20 to 30% of your capital deployed. If you are in a higher volatility environment, you may want to size up because the expectation is that when the volatility is high, it's been reverting and it should go back down. So it may be a good time to have a little bit more capital invested into it. But watch out for when the volatility term structure inverts and goes from contango to backwardation, because that sometimes could be an early warning indicator that the crash is about to happen. Sometimes it just inverts all of a sudden and there's nothing you can do about it. But sometimes if you can watch for that, it could be a good indicator that something is about to happen. Another super important thing is if you look at your entire portfolio, doesn't matter if you have certain naked, certain protection, overall, just count how many short puts you have and how many long puts you have, and take the net value. Is the net, if you have more long puts than short puts, you're good. If you have more long calls than short calls, you're good. If your net number of puts or net number of calls is negative, if you're more short than long, you are potentially exposed to risk. So try to have, at least on a portfolio level, a net positive amount of longer options compared to shorter options. When it comes to the Greeks of the portfolio, remember that more theta equals more risk. Theta risk, even though theta might sound like a good thing, well, higher theta means high risk. And why is that? Because the only way for you to get theta is by selling options, by having short positions. So only the short options will give you positive theta. So if you have a lot of high theta, it means you have a lot of short positions in your portfolio. So again, watch out for that. Higher theta does not necessarily mean a lot of money. It can also mean a lot of risk that you may not be seeing right there. So just be careful with that. The delta, look at your entire portfolio delta. Usually, if you have multiple underlines, you may want to look at the beta weighted delta of your portfolio. And a good rule of thumb would be that your delta, whether it's positive or negative, should not be more than 0.2% of your net liquidity. Again, these are my numbers. You can make your own, but at least these are rules that I try to stick by. Your weighted Vega, I'm not talking about nominal Vega, I'm talking about your weighted Vega for your portfolio should be less than 1% of your net liquidity. Again, keep in mind, if you have a $100,000 portfolio and a 1% increase in VIX corresponds to about $1,000 profit or loss because of the weighted Vega. So that's what it translates to, right? So if you have a $10,000, that means $100 plus or minus because of 1% move in VIX. So that's where these numbers come from. Finally, again, diversify your strategy, diversify your DTEs, your expressions, diversify your underlying. And I mean, long story short is there is no such a thing as a one trade for every single market. It doesn't exist. You have to have different trades and kind of play with them together. A single trade can be very profitable for one time, and then all of a sudden it stops working, and then what? You have nothing else to do. So you have to kind of look at more trades altogether. Finally, you should look at hedging, and hedging should at the portfolio level, and the portfolio hedge should always be on. You shouldn't go and look for hedging when the market crash is happening, because that's already too late. Buying an insurance one day before the hurricane is coming or before a fire is happening, it's not going to help you. Your insurance is going to be way too expensive at that point. So always try to have some level of hedge in your portfolio, always permanent on. So it's a cost of doing business. Put it in as part of your plan. Now let's look at some possible hedges. Here's just some example. The most simple one is buying a long put. You just go with a far out of the money put from 90 to 100 to 150 days to even 200 days away. I mean, farther dated puts. I mean, obviously, if you go far out in time, it means that the theta decay of that long put is going to be very small, which means that yes, it's negative theta, but it's a very small negative theta. That's why you're buying farther dated puts instead of buying a $30 put. $30 put, sorry, 30 days to expiration put is not going to help you. It's going to lose a lot of value very quickly. So it creates a higher drag on your account. But it's not just about that. It's the fact that this structure, if you go to 0.5 delta. In this backtest is I bought a put at 0.2 delta with a 90 days to expiration. And as you can look at the P&L, essentially over the 5 years, it only required 3 events or 4 events in total, and the P&L went all back to even. So yes, you're losing all the way through. So this is a grinding all the way down, but eventually when events happen, this makes money. And why does it make money? It's not because of the volatility. It's because of the it's not because of the Vega. It is in part, but it's mostly because of VOMA and ZOMA, which are the second and the third order Greeks of the sensitivity to volatility shift. And those basically make the price of those puts explode, and that's where you get your return, or at least your protection, essentially, when an event like those of Monday of that August 5th happen, or the COVID, or all those type of events. Now, obviously, buying puts, not everyone is everybody, because again, it's something you pay every single time, and it's always kind of losing money. So you can get a little more creative. Another example would be using a back ratio. So you can sell one put to finance for the cost of buying 2 puts, or you can do 1/3, 1/4. I mean, you can go crazy with these ratios, and you can pick up different distance. But basically, again, farther out in time, kind of farther out of the money. The concept again is to cash in on the VOMA and the ZOMA effect, not necessarily on the Vega, and a slow decrease in the underlying. That's not going to do anything. This is not going to save you from those type of events. It's only going to save you for big events where the volatility spikes a lot, or when there's a sudden drop in the market of 3-4% drop in the market. So this is one thing to keep in mind is, doesn't matter what structure you do, always look at the T0 line. The T0 line should have a positive gamma, should be all the way going up. It should never go below the 0. So that's a sign of a healthy T0 line. That means that this, in theory, if the volatility goes up, this structure is going to gain value, and you're going to get a protection. Another example of protection could be using a diagonal. Now, this would be a structure not far out in time, would be more in the 30 to 50, 60 maximum days to expiration. And again, you in this example is basically about 1 delta far away. So is the long is about 1 delta, and the short leg is a few strikes below, and it's basically just to create a symmetrical structure. Because if you actually look at a put calendar, the left side is actually below the lower line on the left is much below compared to the right side, and that's because of the fact that the interest rates there is high. If the interest rate were 0, then the calendar would be basically symmetrical. So you want to have a structure which is either symmetrical, or even better, maybe the left side even a little bit higher. If you want to have more negative delta exposure, that's fine. But this structure does not make money because of the VOMA or ZOMA, because and the reason for that is that you have both a long and a short, so they essentially kind of cancel each other out to a certain extent. However, this type of calendar is especially done on about 30 to 50 days. When the VIX goes high, the nominal Vega that you see here is basically the same as the weighted Vega, so it's quite representative. And when the Vega goes high for those type of strikes, it goes high for both the short and the long by almost the same amount, which basically means that your calendar is actually truly positive Vega, and it's going to give you some level of protection. This is not a protection, a super protection, but it's a pretty good protection for relatively mild event. And the good thing about this is that it's fairly cheap compared to a back ratio, or compared to simply buying a single like a naked put. And finally, I mean, when everything else is now possible, I mean, you always have the ability, the possibility to hedge using your the future. So you could, for example, you could short one contract of the mini of the MES, and one contract basically hedges 5 deltas of SPX. So you can use that one if you have a, I don't know, a positive 20 deltas of your entire portfolio. You might want to short 4 MES contract to flatten your delta. Now, the pros of this approach is that the future is always, super liquid. There's a very small bid-ask spread, so basically, you can get filled at a very good price, and you can trade it almost 24/7. Well, no, almost 24 hours a day, except the weekends, because obviously Friday and Saturday it's closed. But for pretty much almost every other days, it's almost 24 hours a day. So it gives you a good time to hedge your position if you have to. But what I personally don't like about hedging using the MES or the future in general is that it's super directional. First of all, you are only able to flatten your delta. You're not able to hedge against Vega or any other the Greeks. You can only basically protect your direction, which is not bad, but it's only one side of the equation. But the most important thing is that once you do that, you're becoming very directional. You're making a conscious decision that you think the market is going to keep dropping down, and if the market bounces, you may end up having an even bigger losses because of the hedge compared to the loss that you were already having on your normal position. So once you start messing with the future, it could be a sweet ride or it could be a nasty ride. So just be careful with that. And with that, I know that I spoke a lot, so open up for any Q&A or any questions you guys may have.
I'm positive we'll get some, so let's just wait for them. And while we're waiting for some questions, well, I can answer some questions. And the futures, you brought them into the picture toward the end. How about futures options? In other words, I saw some one presenter, I don't remember who it was, saying that even in tense market conditions, they were getting much better fills on option spreads in the futures, and they were just getting filled instantly without the same difficulty that you have with the directed trades on the outright.
Honestly, I don't know, because I don't trade with the future options. I always trade with just with the normal options. So it might be the case. I don't know. I haven't experienced it, so I couldn't say.
Fair enough. Let me see what else I have here. Do people who had losses, or I know you're in contact with a lot of traders, were they mostly on the downside, or were they mostly on bounces on the upside?
I've seen some of the so it's funny because like in the community of the group that we have, we don't trade naked. Basically, it's not that they're banned, but basically we trade all kinds of other strategies, and but it's a bigger group, so you get a lot of stories and hear about what happens in other ones. Plus, we also got some people that reach out to us. I say us because it's 3 of us, it's not just me in this education company, and they say, well, we experience a very big losses, we wipe out our account, and what kind of trading you guys do and whatever. But the whole point of this is that most of them have either been liquidated by the brokers. I've seen, especially in Europe, a lot of people were using, which is even worse, basically CFDs, contract for difference. These are basically there's a broker called well, I'm not gonna name brokers, but there are some brokers that basically do CFDs. They let you trade options on these CFDs that basically replicate what the S&P is, but it's not exactly the one. And you're not trading on the market, you're trading against the broker, and they are going to liquidate you immediately if anything goes. If you get even close to halfway to your strike, to your short strike. So some people were liquidated by the brokers. Some others tried to use the short the future at the last minute, but then the market bounced back, and then they they suffered losses on the way back because the market, again, didn't drop that much and then actually bounced it back. So it was more kind of a hint of a crash than a real crash. The problem was that the volatility exploded so much, and that's what blew a lot of people. But if you just look at the drop in the market, it was only 3%, and 3% happens, I mean, that doesn't happen every day, but it's well within the 3 standard deviation. It's not that uncommon on the S&P. If you look at the distribution that I showed you before, you had cases where you had minus 10% in one day in the full tail. So those are really big crashes.
Okay, let's have more questions. I'll add another one while we're waiting here. Interactive Brokers has a reputation of great fills compared to other brokers. Is that true? And second, or at least they claim that, let me put it that way. And the other question is, Interactive Brokers has a reputation of being extremely vicious in the way it suddenly increases margins. I think you mentioned this, in fact, as a matter of fact. Did you find both of those true, or either of them?
So the first one is that I think it's reasonably true that you can get some better fills. Because again I have all the three platforms I'm trading both on Tastyworks, Thinkorswim, and NEB, and I find that Tasty has sometimes the worst fill prices compared to EB and Thinkorswim. Thinkorswim and IB tend to be fairly similar in my experience. Now, you always play a little bit with the commissions. One is a little bit higher on one side, and whatever. But so all in all, I would say fairly similar. But EB tends to have good fills, especially with the smart routing. But again, the thing that I was mentioning earlier is that that smart routing, it might be good for certain things, but when you start looking at structures that are sensitive to skew rotation, that algorithm that goes and fetches the best price that it can or whatever in multiple places sometimes give you a very good price on one leg and a very bad price on the other. So yes, on average you get the limit price that you wanted, but when you actually start looking at the Vega effect on those legs, because you had a very bad price, you may actually be at disadvantage. So you and I may actually get the exact same fill price, same structure, but somehow you're doing better than I am on the exact same trade at this exact same time because you get a different feel on individual legs. So that's something you got to be careful of, especially for longer dated options where, again, this can happen more than others. I mean, again, it's not a huge impact, but it can have an impact.
Okay, who else has some questions or comments? Ron, you must have some comments. Maybe not.
Hey, Don. Yeah, I agree with pretty much everything Rocco's mentioned. The one thing I guess I'll add, I mean, for my community, I did like a 4.5-hour presentation on this stuff and lessons learned and all that kind of stuff. So there's, a ton to get into, just similar to what's been talked about here. But one of the key things that hasn't been mentioned so far is broker specific. And in this case, it's with IB. And the thing and you'll only typically notice this during a crash event, which obviously doesn't happen very often. So it can take people by surprise. And that is that at most other brokers, when I say the mark price, everybody thinks that that's transferable with the mid price. Okay, basically the midpoint between the bid and the ask. With interactive brokers, that is not the case. And they're, as far as I know, the only broker that actually does this. And so they do have a mid price, but they also trade the mark price, and I'll get into the mark price in a sec. But the mid price is essentially only used, and remember, mid literally is the midpoint between the bid and the ask. That is only used when you submit a new order. So if you put in an order for a broken wing fly or a butterfly or a vertical or whatever, then in the order box, you'll see mid there. Okay, that is the true mid price. So to help you enter into that position or to exit from that position. But, and this is a big but here, everything else, in other words, your P&L for all of your actual open positions, your Greeks, your risk margin, all right, which can definitely trigger a particular level, and then you can get liquidated at IB, which they do more than happily, right? Like with TDA or with Schwab now, they're far more lenient, if you like, in terms of not liquidating you immediately, but IB are super aggressive with that. And not only that, but they'll liquidate you outside of the regular trading session. That's another big difference between IB versus, say, now Schwab, right? That you might get an email notification from Schwab now telling you, hey, you've your margin's too low, you've gone over your particular limit, but that's primarily due to the craziness that's going on outside of the regular trading hours, but they won't liquidate you until the session actually opens with the normal regular trading hours. And normally by that point, everything kind of stabilizes, at least somewhat, compared to the non-regular trading hours. And then at that point, you're back to normal. Okay, so therefore you don't get liquidated. Whereas at IB, when you're outside of the regular trading hours and things are going insane, they will happily liquidate you outside of regular trading hours. And that's the danger point. Okay. And I've personally heard some stories of that actually happening during this particular crash too. Now, getting back through to the original point. So remember, mid price is only used for the order ticket, essentially, to open or to close. Now, the mark price I mentioned is for everything else, for the P&L, for the Greeks, and for margin. And the mark price is not the mid price at all. Okay, so what happens is that picture like the bid and the ask. And so what happens is that if the last traded price is between the bid and the ask, the mark becomes the last. So the mark is not the mid, it's actually the last. Okay, if it's between the bid and the ask, well, that's the so-called best case scenario in terms of something that it's not going to be too different between the last and the mid price compared through to another broker during normal trading conditions. But when you have a crash and things go insane, especially outside of the regular trading session, now if you again picture the bid on the left and ask on the right, now if the last trading price is to the left of the bid, the mark becomes the bid. And similarly, again, bid on the left, ask on the right. If the last price is to the right, as in higher than the ask price, then the mark becomes the ask price. Okay, so now the mark could either be the bid, the ask, or the last. It's never the mid. But when it's the bid and the ask, when you see that there's like 100 or 200 point gap difference between the bid and the ask, and not only that, but they're wildly jumping everywhere like they're, crazy, your P&L is going to be doing that. But more importantly, your portfolio margin calculation will be doing that. And that will happily liquidate you based on those insane, unrealistic prices outside of regular trading hours. So that's a big one to watch out for with IB.
Yeah, I found that like I was trading futures options, like more on commodities indexes, but sometimes they have models like where they think the market is thin in futures options anyway, commodities.
Yeah,
they have their own model and they don't go by the prices really. And so they can get for distant months, and they can be just wild numbers. And it's I sort of gave up on interactive brokers really for their with some experience in that.
Yeah, no, they're so-called conservative, but they're conservative to protect their own asses. So they will just liquidate you at a moment's kind of notice. And actually, going to a point from Rocco, again, I'm not meaning to contradict anything you're saying, but in this case, it's relevant to one of the points that Rocco brought up, which is trading further out in time. So I'm also a fan of trading further out in time for a lot of the structures that we do. But just know that during a crash event at interactive brokers, this issue of the mark price actually being the main thing that is tracked, that becomes far more volatile for further dated expirations at IB. And even at IB, depending on how far out you go in time, they will even sometimes charge you a penalty fee when you check all of the actual granular charges in your bill as a penalty fee for trading too far out in time. You're like, what? So, yeah,
concentration fee, right?
Not just concentration. That actually in their opinion, it's riskier for them to be trading it because things are less liquid. So therefore, they're happy to charge you a penalty for doing that.
Both. They'll also charge you a concentration fee for being risky, for being too concentrated in one particular. area.
Yeah. So yeah, with IB, you really have to kind of watch out, especially during crash events.
Yeah, that's a very good point. I mean, on one side, if you think of how they calculate the market price, the mark, right? One could argue, well, if the last was executed at a certain price, it doesn't matter what the bid and ask was, the market price is the last because someone was willing to pay that price to get filled, right? So now, having said that, I mean, it's kind of crazy because like, how can you get filled at, worst price in the bid and ask when the market maker is supposed to fill you at the bid or at the ask? But yeah,
But even that, like when you say someone was willing to pay that price, I don't know if I like the word willing. Do you know what I mean? So somebody was forcibly executed at that price and liquidated, and now
Yes.
suddenly that becomes the last price for the next person.
Yes.
You know?
Yeah.
And then it's like a snowball that everybody keeps getting executed at these horrible, unrealistic prices and liquidated. So yeah,
The bid and ask don't really have to mean anything because, you may have, liquidity on one side of the market and not on the other.
Well, but if you're a market maker, you're forced to have both. You need to
Yeah,
quote.
but their bids can be way back. They will pull their quotes way back. And so in some cases, you're left with dealing with more amateur. If the market moves hard, the first thing they'll do is they'll pull out the close by bid and ask, and you're stuck with a bid or ask that may be quite a distance from the real underlying market. But you're the one that's been dealing with this. So did Ron, any other points?
Yeah, I guess the main one to watch out for is with IB. I don't mean to be picky with them, but again, during crash events, there's a whole variety of things that they do that other brokers just do not, and therefore increases your risks. I know that Rocco mentioned here futures. That is a pretty important point too. Like even within my community, even though I've been teaching this, for years now, as well as one of the methods of what you could do for reactive hedging. The reality is that during normal times, people don't feel the need to do that, and therefore they don't get practice with trading futures. And it is such a useful thing to learn. And it's especially useful for crash events. Because again, when you're looking at an option chain and you either don't see, we've got screenshots of option chains with like blank bids. There was like nothing there. It doesn't just say, a price, which is insane, which might be 200 points away from the ask. It's just nothing, right? So you have no idea what the hell the actual price for that thing is. And it's obviously just unrealistic to be able to trade during a time like that. And during those times, if you know what your portfolio deltas were or are, then you can very easily then hop over to futures and then hedge off your futures, your delta exposure at least, with MES or with ES. And in particular, in this particular case, things started getting ugly pretty quickly on Sunday night at 6 p.m. when the futures actually opened, and we were all looking at our screens. And I'm actively telling my community, look, if you want, you can hedge right now. You don't have to wait until Monday morning. And the markets just kept going down and down and down and down overnight, and that could have actually helped you quite a bit. The fact that you can trade futures, as Rocco mentioned, almost 24 hours a day, apart from not being able to trade on the Saturday. Or most of Sunday, but from 6 p.m. on Sunday, your futures are going to open, and from that point through to pretty much the end of Friday, you've got almost 24-hour a day trading. Now, I'm not suggesting that you have to be watching the screen 24 hours a day, but one of the useful things that you can do if you want is to just set certain levels. If it breaks this particular level, then short one future. If it breaks this level, short another one. Most of the time, those things don't get hit, so you can just tweak them on a day-to-day basis. You don't have to be actively looking at the screen. But if you are looking at the screen as well, it's just very useful to at least be familiar with the execution side of what it looks like, so that you're not panicking during the crash event going, oh my God, I don't know what the hell's going on. How do I submit an order to short a future and all that kind of stuff. So, my advice there is get some practice. Just, do a single MES future, something tiny, but just get used to the execution side of trading futures, and don't make that be like something scary. It should be something very simple to do, and it's just a very useful tool because even during crash events, your bid ask on MES and ES is like 1 or 2 ticks. It's like nothing. It's super tight. So you want that, you know, like when you've got a bid ask spread of 100 to 200 points in options, and you can get a 1 to 2 tick bid ask spread in futures. Well, I know what I'm picking.
Yeah.
That's a very good point. Thank you, Ron.
Okay, let's get some questions from other people or some comments in here. Who can say, ask a question? Just ask Rocco a question. It's been quite interesting, you know, because, by the way, we currently have 9 live viewers on YouTube, and had 29 people on YouTube. So it's, although the count is a little bit low on the Zoom participants, it's part of it is just migrated over to YouTube because people are looking at it there. I don't see any comments from the YouTube people. You can type in a comment too on YouTube, and I'm watching for it. Was anyone else trading? How are other people affected by some of these events? Or did everyone just stand aside? I know some of you are very involved in the markets and trading them very actively. Okay, Andrew says, very good point about the legs getting bad fills on different exchanges and then being affected by the skew. Can you get around that by using affected?
I think you might be able to switch and use different, instead of using the smart routing of EB, you can tell not to use that one, and it will force into a single exchange, which should give you more reasonable fields on individual legs, because they're going to be on the same, perhaps the same market maker, so it may get a better value. But it was funny because like I was taking a position, and all of a sudden I was looking. I had an at the money structure, and I had like a short call and a short put on right there, and the price, even though you would think that the put call parity would mean anything, but then I look at the actual field price, and it was like $10 apart. It was like, what the heck is going on? And so obviously during the day, the theta was not working properly because one was overpriced, the other one was lower. I mean, like it was weird. So that kind of started. I started looking at this a little bit more, and I noticed that it happens more than I was hoping for. But so anyway, just something to watch out, especially for structure that are sensitive to skew.
I've heard, Rocco, and this, that in respect of what you just said, that sometimes they're really filling the spread, and they just put arbitrary numbers on the 2 legs. I mean, that's probably improper if they do that, but I'm told that often happens.
Yeah, but when I do place an order, I don't trust the mid from IB. I mean, like I look at the mid across all the 3 platforms. Maybe I have an OCD or whatever, but I do look at the mid for all 3 platforms and say, okay, what's a fair price that I see across all these three things, and that's my kind of starting point for deciding where I'm gonna put my limit order. I'm not gonna trust the mid that comes up. I don't know if you guys have that experience, but like when I look at the mid on TWS from IB, it's like it's all over the place. Like you never get like a real number out of that thing.
Yeah, I don't think it's a real number though. And I agree with you. Okay. Andrew, do you have any other comments? Were you trading? How did you find trading in this environment? Anyway, one other question: let's suppose you have the market really moving wildly, like this, as we did. How do you keep your head? In other words, you're madly trying to compute Vega and Gamma all over the place and all that. Can you really maintain a rational perspective on this or is this because if you can't, does that mean you're over trading?
Yeah, I think you kind of answer yourself there, Don. From my personal experience, is if you are panicking, it's because you're trading too big for whatever reason, right? Or either you did it consciously, or you didn't realize that your position was bigger than you were hoping
Yeah.
for, or you didn't calculate your margin correctly, or whatever. So the reality is, that's why I said, like, do not count on you saving the day. You should start with the assumption that you may not be able to even trade it day, because of all of the things that happen during a crash. So your portfolio should save your day by either having an edge right there to a certain extent. Obviously, nobody's perfect. I mean, but to me, it's like if you're losing your mind, probably it was a little bit too big, right? Or something that you had not expected to happen, which can happen to anyone, because there's so many different variables in this game that it's hard to keep it all.
Sure. Andrew said he removed most of his positions on the Friday before the crash.
That's a good point.
I guess, is there any, do you think that the broker software is adequate to even trade these markets, or? You say we got behind at times, or?
It's well, I don't know. It's like I mean, if you think of Thinkorswim, that they you couldn't even log into the platform. I mean, it's kind of crazy that you can log in just at the when you need it the most. But the reality is, probably everybody was freaking out, and everybody was trying to log in at the same time on Monday morning on 9 a.m. So it's I mean, yeah, we can complain as much as we want, but the reality is, we are subject to whatever the broker is doing, right? We have to live by whatever rules they come up with, whether they increase your margin or whether they liquidate you. Like, unfortunately, it's not exactly a democratic process. And so the only thing one can do is, having already in their mind that this thing can happen, at least try to remember this thing can happen, right? So now there is no solution for everything. I mean, some of these things are basically, outside of our control. But knowing that this could thing can happen, you can make your own plan. Again, maybe it's trading smaller, or having other plans, or maybe if you have two accounts, right? One doesn't work, you can go to the other. I mean, yeah, if my TOS wouldn't work, I mean, I could still trade with EB. I could still trade with testing. I mean, you can try to do some hedging, right, with the other platform, if you have more than one. At the same way, when you have a bank account, which is all the bank accounts are insured by the FDIC for $250,000. But if you have $500,000, you probably don't want to keep the whole $500,000 to a single bank. You may want to split into two and give it to two different banks. So the same thing you could do with a broker.
Okay. Oh, that's so good. So many good points have been made by Rocco and also Ron. Anybody else have any further comments? Oh, Rocco, did you want to mention your courses or whatever?
No, not really. It's because first of all, they're all in Italian, so unless there is anyone Italian that wants to.
Okay, if anyone gets Italy is looking at optiontraders.it.
Yeah.
And otherwise you'll have to catch him on some of our meetings.
Anyway, I mean, I left my email because you guys can reach out to me, or you can if you want to talk about trading. I always love talk about trading. Again, I don't do this speech to sell my courses or anything else. I mean, it's that's a different story. I do it as a passion, and
yeah,
it is what
that's
it is.
great. That's true. We really appreciate it. Ron, did you have any final points?
Well, I guess two things. One of them, and I don't mean to sound self-serving, it's just I want to caution people, right? And that is that just be careful who you learn from. There are a lot of people that have done this 1-1-2 trade that's become quite popular over the last year. I won't mention the gurus because I don't want to point even more people to them, but I was personally contacted by people that got wiped out. I've got people in my community that have friends that was doing that trade that got completely wiped out. Others that had an 80 or 90% loss. Just really, really, really bad.
Is that like selling twice as many
It's basically a put debit spread at the front and then a naked put at the back. Right. So similar
They
to
have
what Rocco was.
an extra put.
Yeah. Yeah.
Yeah, I
So
agree
it's like a hedged
completely.
naked put kind of thing,
I
right?
agree completely.
Um,
At very least, as Rocco said, you should have the same number of, at least the same number of long as short.
yeah, but it worked great while the market was going higher. Great win rate, as they love to say, like Rocco was saying. I don't know if you saw my comment, Rocco. I basically said
Yeah,
Russian roulette has a great win rate too. So, um, and that's very real, and that's part of my concern that there are some people out there now that just to try and build up their YouTube channel, they're trying to, tell people or teach people about portfolio margin style trading, and that's really dangerous. If you don't know what you're doing, you can literally get completely wiped out and then some. Because remember, portfolio margin applies a ton of leverage essentially through to your trading. And if you've got $100,000 account, you might say, oh, it's terrible if I lose my $100,000 account. But guess what? You can not just lose your $100,000 account, you could lose your house, your car, everything you've got, right? Because you could be exposed for millions of dollars of exposure and they'll come after your assets. So it is dangerous stuff. You have to know what you're doing.
yeah, and
So
it's so funny because like hedging and risk are not popular subjects. Like I knew
yeah,
right away when we scheduled this talk that we wouldn't have. Now we had got a great turnout. We got between the two, but even still, whenever we've held a talk on risk or hedging, it's not going to be a big draw. I
mm.
know that. People
But
don't want to
it's
hear
ironic because it should be the complete other way around.
exactly.
It should be the most popular sessions. So yeah, so just be careful. There's a lot of people on YouTube out there just, trying to either build up the channel or whatever. But during crash events, tons of people will get wiped out, as happened here. Even they themselves took hits and they showed their accounts on the assumption that what they showed is not a lie. They were showing roughly about 50% drawdowns or hits on their own accounts. Okay, and these are the gurus taking 50% hits, and their students took hits where they got completely wiped out in some cases. So yeah, just be very careful, I guess, is the main thing to put out there. And then the second thing I guess I'll say is, because I get this question all the time, and that people get hurt during an event like this, and therefore, at least for the next few weeks or whatever, they now are interested in saying, well, how can I hedge my portfolio, and therefore how much money should I spend, and all that kind of thing. My typical advice for that is, I mean, of course, the ideal scenario is you come up with some magical hedge such that you never lose money during a crash event. Everybody wants that, okay? But that's just completely unrealistic. So and I'm not suggesting it's easy to do, but the typical advice I give here is that you want to create a hedge such that your planned max loss is contained to roughly about that level during a crash event. Okay, so if you've got a trade that you say, I make $1,000, that's my profit target. My max loss is, $2,000 to $3,000 is typically common. Most people use a 2 to 3 times multiplier, more or less. Let's say it's 2.5K, and you've got thorough backtesting, both manual and automated, to show that over hundreds of trades and crash events historically that this is the stop loss that you kind of get out of. Okay, so you say, okay, I've got plenty of data now, not just wishful thinking, telling me that hopefully I can get out at 2.5. I've got data, hundreds of trades that show that yes, at least with backtesting, with its own limitations of, potentially unrealistic bid-ask spreads and always choosing the mid price and all that kind of stuff. But let's put that to one side. You've got tons of data saying, the backtest showed me that I should be able to get out at 2.5K. Then the amount of hedging you want to have is such that during crash events, your max loss is contained to around about that level, 2.5K to say 3K or something like that, right?
So
Can
I
you
have to
spend more
run
on it?
simulations to determine that?
Yeah, absolutely. But the thing is, I think that's a good mental thing to put in your head. So in other words, most people actually don't think about it that way. They want a hedge such that it nullifies all losses during a crash event. I'm like, that's so unrealistic because that's so expensive to do that during normal times you'll be losing money. Your income trade won't be able to offset or make more money than that particular hedge. So overall, your risk adjusted returns are going to be rubbish. Okay, so absolutely spend money on proactive hedging. always, but size it such that during a crash event, you can keep your losses contained to roughly your planned max loss size. So in this case, per trade, let's 2.5K to 3K, not a scenario where you get a crash event and suddenly you're down $100,000. When you were planning to be down a maximum of 2.5. That's the key, I think, to get a rough idea of how much should you be spending on proactive hedging. There's also a whole variety of things that you can do from a reactive hedging perspective. But as Rocco has mentioned as well, sometimes you can't guarantee during a crash that you can even log onto your platform. So that's why proactive hedging is so important to always have in place, some degree of it anyway. And in terms of how big should it be, I think that's a good guideline to go with.
Yeah, and Ron has a lot of expertise in that area from original Black Swan hedge, was one of his famous videos right from the start, and I know he's still concentrating on hedging a lot. Rocco, any final comments?
Rocco, you're muted, I think.
Can you guys hear me?
Yes.
Yeah.
Oh, thanks. No, that was a very good point, Ron, because I also kind of make me think of when you buy insurance, usually you have a deductible on your insurance. So you don't cover your entire amount. You always leave some deductible that you're willing to pay out of pocket if you make a claim, because if you were to be covered 100%, your insurance costs will skyrocket.
Yeah.
And so it's kind of the exact same point. So it's very, 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 very relevant.
Huh, that's true. Absolutely true. Thank you so much. A fantastic talk and fantastic discussion too. And I guess, and I love that we had YouTube viewers here, and there's now more YouTube viewers left than there are participants on Zoom. So I think we've learned that YouTube viewers maybe have our night owls. So thank you very much, and we'll just close it off there. Thanks so much.
Thanks, everyone.
Thank you.